Hello, beautiful people, and welcome to this week's edition of the ITU Forex class. In this week's class, we're going to be talking about swing trading strategies that work. Okay, so we're going to be talking about swing trading strategies that have been proven to work, and that's strategies which traders have been using to do swing trading, which have been giving them good results in the market. Okay, so before we dive right into the class, first things first, what in the world is swing trading? Okay, so if you've been trading for any length of time, I know you must have come across the term day trading. Okay, so I know you must have pretty much heard about day trading, and maybe if you've been trading for, if you've been in the community for some length of time, considerable length of time, you must have also even heard about scalping. Okay, these are all types of trading. Okay, they are styles of trading which traders adopt, which swing trading is just one part of it. Okay, so what exactly is swing trading? What exactly is swing trading? And before we actually talk about the strategies, let me break it down for you in a way that would help you to understand. Okay, so there are basically two ways for you to make money in the markets, especially if you're trading markets like the forex market. Okay, so you either buy a tradable instrument when its price is cheap, and then wait for that instrument's price to increase in value. Then you close your trading position to bank your profits. Okay, to bank your profits. So if this is what you're doing, this is one way to make money in the forex market. The other way is for you to sell a tradable instrument when its price is expensive, and then you'd hope for that instrument's price to decrease in value so that when it goes down, you're actually going to close your short trading position so as to bank your profits. Okay, so this is one method, and this is two method. Now there are whatever trading style you're using, you are basically using an iteration of one of these two things. You're buying low and selling high, or selling high and buying back low. Okay, now where these trading styles come into play is when you talk about the length or the period with which you hold your trading positions for. That's the duration. Okay, so for scalping, most of the times you'd see that scalping is a trading style where traders, they just get into the market and hold the trades they open for maybe 1 or 2 or 3 minutes. For example, you understand, they don't hold trades like, for hours on end or for days on end. That is completely not how scalpers trade. Scalpers, they basically hold trades for only a couple of minutes when they get into the position. So they are basically getting into a trade, and they want to buy low and sell high, because that's one of the things you have to do to make money in the market. They either buy low and sell high, or sell low and buy high, but the duration with which they are going to hold that trading position is actually going to be very, very short. And as a result of this, they are usually going to be trading very, very short time frames, like the 1 minute chart. Maybe it's very rare though, but you could see maybe some scalpers might also be taking trades based off of the 5 minutes chart. But that's rare because their trading positions usually don't last very long, okay? So maybe if they're looking at a 5 minutes chart or whatever, they might just be using it for multiple time frame analysis, or whatever the case might be. But by generality, okay, scalpers, they hold their trades for very, very short periods of time. They get into the market, maybe they try to squeeze, scalp maybe 2-3 pips or whatever, with relatively huge position sizes, with good risk management, obviously, and they just get what they can from the market, and then they just get out of the market immediately. Now, right next to scalping is day trading. Day trading, on the other hand, remember, we're talking about how these are the modes, the styles that traders use to make money, extract profits from the markets. Okay, so I told you that for you to make money from the markets, you're basically going to buy low and sell high, or sell low and buy high. But where these trading styles come into play, where they are different, is the holding times, the duration that you hold those trades. Scalpers, they basically buy low or sell high, or sell low and buy high, or sell high and buy low. But the trades that they open, they are very, very short. maybe lasting from maybe a couple of minutes to at most maybe 10 or 15 minutes. But day traders actually open trades, and then whatever happens, they make sure that at the end of that trading day, they do not leave the markets with trading positions that are open within the markets. So, for example, let's say a day trader starts trading when it's London session, okay? It's a London session. He places a trade, maybe a buy trade at the beginning of the London session. And at the end of that whole trading day, the last session that is going to come into play is the New York session, for example, NY session, okay? Now, for a day trader, he is not going to leave the markets or leave his trading station with an open trade in the markets. If he opened the trade during London session or during Sydney session or whatever session he opened the trade, he would make sure that before he leaves his chart, before he leaves to go to sleep or whatever the case might be to do other things with his life, he will make sure that he is flat in the market with absolutely no open trading position. That's why he's called a day trader, because whatever trades he opens, he actually closes those trades within that same trading day. No trades stay overnight for the day trader, okay? And then the third trading style which we're going to be talking about, which is what the strategies that we're going to be talking about in this week's class revolve around, is known as swing trading. Now, swing traders, as opposed to scalpers and day traders, the duration that they hold their trades for usually lasts longer than those of day traders and scalpers. Remember, scalpers tend to hold their trading positions for very short periods of time, maybe a couple of seconds to a couple of minutes. Okay, they hold their trading positions, they get in and they get out. You know, they maybe take their small profits or small losses. Whatever happens, they don't hold those trades for hours on end. Day traders, on the other hand, remember I just explained this to you. Day traders do what is known as day trading, which is they open a trade within a given trading day, and they make sure that they don't end trading for that particular day with an open trading position. They make sure that before the end of that trading day, they close whatever open trades they open. Now, swing traders are different in the sense that whatever trades they open, those trades could last from a couple of days to maybe even a couple of weeks. So it's not uncommon for you to see a swing trader opening a trade at the beginning of a trading week, like on Monday, for example, only for him to have that trade open throughout the week, or maybe even open till the next week, next trading week, or even more than that. It's not uncommon for swing traders to do that. Now, the thing is, because of the nature of how they are trading, swing traders are trading, most of the times what you discover is that they usually are trading off of the higher time frames, like the 4-hour chart or the daily chart, okay? Or rarely you could see some traders who are trading on the 1-hour chart, okay? It actually does happen, okay? Now, all of these trading styles, they have their positives and they have their negatives. They have their pros and they have their cons. The idea here is for you to evaluate yourself and then see what type of a trader or what type of trading style resonates with you the best. So, for example, there are traders that the idea of opening a trade on Monday, for example, at the beginning of a trading week, and then holding that trade till the end of the trading week it sounds like watching paint dry. They are not just that patient. They want to be in and out of trades very quickly. So for that type of trader, even though you have a trading strategy that is profitable, like a swing trading strategy which is profitable, if you give that trader that particular type of strategy, because the trades that he's going to be holding are going to be very long, and maybe his trading style, his trading personality is more inclined to scalping as a trading methodology, that trader is going to find it extremely difficult to stick with a swing trading strategy. So you need to understand, okay, am I the type of trader who doesn't like holding trades for very long? And not just that, do I have at this particular moment in time, does my lifestyle afford me the opportunity to stay in front of the charts for hours on end, looking for trading positions or placing trades without, having to attend to some other issues, like maybe attending to my 9 to 5 or going to school or doing things like that. Because in as much as you might want to be a scalper or a day trader, if you don't have the time, or if your lifestyle does not afford you the time to spend in front of the charts, then it's going to be difficult for you. Okay? And this brings me to the crux of today's class, what we're going to be talking about moving forward. Okay? Swing trading is a trading style which is much more suited for people who are very busy professionals. Okay? So for example, let's say you have a job. Or let's say you're a student and you go to lectures, you can only give the charts or the markets maybe 10 to 15 minutes of your time in a given day. That's all the time you can have, for looking at the charts or taking trades or managing those trades or doing anything related to trading. Then swing trading might just be the best fit for you, because swing trading doesn't take up much of your time. If you have a proven trading strategy that works, all you need to do is open the charts, look at the price action on the charts, and see if you have a trading setup or not. If you have a setup, you place the trade, and that's it. You don't need to be babysitting the trade and, looking at the trade every single minute to see how it's doing or whatever. If you're a swing trader, you don't need to do that. You don't need to do that. So swing trading is best for busy professionals, okay? Now, with that out of the way, let's quickly go to the charts so that we can talk about the strategies, the swing trading strategies that actually work, okay? Which is the crux of what we're going to be talking about in today's class, since we've already laid down the foundations now. So what you're seeing on my chart right now is the 4-hour chart of the GBP JPY currency pair, okay? So like I told you, the strategies that are used for swing trading are lots of them, but we're going to break them down into 3, okay? The first is a trend trading strategy, okay? If you've been attending these classes, you know we love our trend trading here. So trend trading is one of those methods, okay? Is one of those methods. So let's say number 1 is trend trading. Number 2 is actually range trading. Okay, this is when you're trading support and resistance. Okay, when price is not trending, it's stuck within a trading range. Okay, range trading. Okay, and this number 1 is broken down into 2 actually. Okay, we've got breakout trading, and we've got pullback trading. Okay, pullback. So let's talk about each one of them, okay? And this particular chart gives us a beautiful example of all of them, okay? So if you've been attending any of the classes, you know we've been talking about market structure. And basically, what market structure is the method or the type of, is the behavior of price, the way it moves in the market. So just because a particular tradable instrument is in an uptrend, that doesn't mean that that particular instrument is just going to move up in a straight line. It's usually going to move up a bit and then it's going to pull back slightly higher than where it started from in the beginning, okay? And then this is what we know, this is what we call a higher low, okay? Let's say this was our low, our beginning low, okay? This was the origin point and this was our high. So this is a higher low, and this, you can see, slightly higher than this previous one. This is our higher high, okay? And this, again, is our higher low. This is market structure. In an uptrending market, price, even no matter how strong that trend is, price is not going to move up in a straight line. It's going to move like this. It's just like taking 2 steps forward, 1 step backward, 2 steps forward, 1 step backward, okay? That's moving higher highs, higher lows, higher highs, higher lows. This is how price is going to move during an uptrending market. You can see that here we have a higher low, okay? Why? Because this low is actually higher than this previous low, okay? So this is how price moves in an uptrending market. Now, one of the strategies that we're going to be talking about today, which is under the trend trading category of strategies, is the breakout strategy. Now, if you're trading based on a trending trading strategy, okay, and you're using the breakout trading method, the idea is that you're only going to be taking trades when price breaks above or breaks out of a resistance area which it couldn't break above previously during an uptrending market. So in this case, let's say price began its move from here, which is this low, and then when it reached this high, it couldn't break past this high, and then it made a pullback, which created a higher low because this low is higher than this previous low. So already, this is showing us that it looks like price is really in an uptrend. So if price is truly in an uptrend, it would have no reason whatsoever to break below this low, because in an uptrend, the method that price used to move is forming higher highs and higher lows, and this is what we are having on the charts. So let's say that you spotted this, and then once you spotted that price is finding it difficult to break below this low, this would be your cue to say, okay, it looks like we're in an uptrend. In this case, you could place a buy stop pending order above this high, because the idea is that if price breaks above this high, then it's going to continue moving higher, forming higher highs and higher lows. And this is exactly what happened, because during an uptrending market, price is going to form higher highs and higher lows. So when it breaks above resistance, it's usually going to form a high which is higher than that previous high, and that's what you are banking on. The second method, the second strategy, is a pullback trading strategy. So instead of you getting into a trade by waiting for price to break above the level that it failed to break above previously during an uptrending market, the idea is you would wait for price to pull back from the area which it couldn't break above. And then when it makes that pullback and you start seeing it struggle to continue moving lower, and then you see the formations of candlesticks like a bullish engulfing candlestick like we have here, for example, you're going to take your trade here, because you are banking on the fact that if this is truly an uptrend, then price is eventually going to break above this resistance. So you're going to take your trade here, place your stop loss. If you're using a conservative stop, just right below where you entered the trade, or right below the portion where price is finding it difficult to break. Or if you want to take this is an aggressive stop loss. Or if you want to take a conservative stop loss, then you're going to place your stop loss below the low, which price found it couldn't even test. Okay? Again, I kept talking about this in previous classes, okay? If you're using the conservative stop losses, your stop loss is going to be wider, which in turn will mean that the trades you take are going to get stopped out a lot less often than somebody who is using an aggressive stop loss. But the cons to that is that since your stop loss is wide, let's say, for example, you're risking 100 pips on this trade, on this particular setup. From you entered the trade somewhere here and your stop loss is somewhere here. If you're risking 100 pips on this trade and let's say you're using a fixed risk to reward ratio of 1:2, this would mean that you're risking 100 pips to make 200 pips. So if that 100 pips after doing your position size calculation means that you're risking only 1% of your account capital per trade, if you're trading with a 1:2 risk to reward ratio, then your profit target will mean that you're aiming to make a profit which is 2% of your account capital per trade. But the problem with this is that even though your win rate is going to be slightly higher than somebody who is using the aggressive stop loss, yes, you might not make as much profit as that person would make if that person is trading with a high risk to reward ratio. Because for the second person who is using an aggressive stop loss, even though he might enter the trade here and his stop loss is very tight, maybe just somewhere here, even though his stop loss might be something like 30 pips, okay? Which means that if price just slightly moves down, he's going to get stopped out. The thing is, if he's trading with maybe like a 1:5, for example, I'm exaggerating here, 1:5 risk to reward ratio, meaning he's risking 30 pips to make 150 pips. If he takes 100 trades, for example, and you also take 100 trades, and let's say that his win rate is only 40%, while your win rate is 50%. Okay, in this case, let's quickly do the math so that you can see what your profitability is going to be. Okay, so his win rate is 40%, while your win rate is 50%. Let me bring out my calculator so that we can do the math. Okay, so for this particular example, for the person who is trading with a 1:2 risk to reward ratio and he has a 50% win rate, this would mean that out of 100 trades, 50% of those trades were winning trades. And every time he took a winning trade, the profits he made from his winning trades were 2 times what he was risking. So he was risking 1%. So because of this, 50 times 2 would give you a gross profit of 100%. But don't forget he's losing trades. His gross loss was also minus 50%. So when you subtract this 50%, okay, from his 100% profit, okay, you'd end up with a net profit of 50%. And he has a 50% win rate, which is not bad. Come to think of it, it's not bad. But for somebody else who is trading with a 1:5 risk to reward ratio, who is using an aggressive stop loss, you see his win rate is very low. It's actually 40%. Okay. In this case, whenever he takes a loss, because he's risking 1% of his account's capital, he's only losing 1%. So 1 minus 1%, because each loss is minus 1%, times 60 trades which he took. So his gross loss is going to be minus 60%. What about his profits? His profits is from each winning trade he took. Whenever he won, he made a profit which is 5 times what he was risking. So 40 winning trades times 5% would mean he made a profit of 200%. But this is not his net profit. So you have to subtract his gross loss from his gross profit to get his net profit, which in this case is going to be minus 60%. So you can see that he would end up with a profit of 140%. So even though this particular trader, okay, let me pick my pen here. Even though this particular trader who is using an aggressive stop loss has only a 40% win rate, he would have ended up with a 140% profit. While this trader who has a higher win rate, slightly higher win rate, which is 50%, because he's trading with a lower risk to reward ratio, he would only end up with a 50% profit. With a 50% profit, that's all you'd end up with. Okay? So just like with all the other classes, you need to decide for yourself what type of a trader you are. If you're a trader who knows that trading with a strategy which will give you a low win rate, which for this particular example is using the breakout trading strategy, the pullback trading strategy with tight stop losses, aggressive stop losses. If you know that you're a trader who, if you take like 5 or maybe even 6, 10 losing trades in a row, is going to destabilize you and make you to stop following your trading plan, then trading with an aggressive stop loss or a tight stop loss might not be for you. Even though having that higher risk to reward ratio would result in more profits. Because you cannot stick to the rules of the strategy when you're in a drawdown, that might not be the approach which would be conducive for you. So if you know you prefer having, a slightly higher win rate, and your losing streaks are not going to be lasting forever or whatever and make you break your rules, then going for the conservative approach might just be the right thing for you. Okay, now we've talked about the trend trading strategy. The other method is the range trading strategy, like I told you. And the way the range trading strategy works is simple. When the market the market either exists in an uptrend or it doesn't. And when it doesn't, it's usually going to start consolidating. So you can see that price moved from forming higher highs and higher lows in this particular example to when it reached this high, it couldn't break any higher. You can see that price tested this here and it failed to break any higher to continue moving in the direction of the trend. And in fact, this wasn't our warning signal. Our warning signal was around here. Because you see, price was forming higher highs and higher lows, higher highs and higher lows. But then all of a sudden, when price formed this higher high, and this was our previous higher low, price came all the way down here and it broke below this higher low. If a uptrend is really a healthy uptrend, what business does price have coming to break a higher low? Because it's just violated our market structure. So price has no business whatsoever, if the uptrend was truly healthy and truly intact and in place, to come all the way down here to break a higher low. So breaking this higher low was our first warning signal that it looks like this trend is likely going to maybe reverse or switch gears altogether. And so when price came all the way here and it couldn't break, it moved from here to break this higher low. And then when it retested this area, it couldn't break above this. This was a trade in a ranging market because we moved from being in an uptrend to now price is stuck within kind of like a trading range because price could not break above this resistance to form a new higher high. So when you see this, this is a range trading opportunity because when price came here, it couldn't break this high. And before price did this, price actually broke below this higher low. So in this case, this was a swing trading opportunity where you would have shorted this resistance area, okay? So let's say you took a short trade here, your stop loss being above here, because the idea is that if price is able to break above here, then maybe the trend is continuing to the upside. But if price fails to do that, then this is a trade setup which is worth taking. In this case, let's say you're risking something like 50 pips because your stop loss is above here. If you're going for a 1:2 or 1:3 risk to reward ratio, price would have easily hit your profit target because the trend switched and it reversed. So you can see that we went from taking trades during the trending market here to taking trades during a ranging market when the market switched its directions here, okay? And this is exactly how you can use the swing trading approach. But the thing is, I want you to pay attention to this time frame that I'm trading. When you're swing trading, you're not going to be trading off of the 1 minute chart or the 5 minute chart or whatever. No, you're going to be, the least time frame is going to be the 1 hour. Because by definition, when you're swing trading, the trades that you're going to take are going to last anywhere from a couple of days to a couple of weeks. So this particular setup, which we would have seen here, it would have lasted for a couple of days here, because each candle you're seeing on this chart, it actually took it 4 hours to get completely formed. Okay, so this would have been a trade setup which would have taken you a couple of days. The same thing with these previous ones, the same thing with all of this. But if we're trading on the 1 minute chart, then it wouldn't have lasted this long, because obviously if you're trading on the 1 minute chart or whatever, the 5 minutes, you might just be scalping or day trading. And so your trade length is going to vary based on the time frame you're trading off of. Okay, so before we wrap up this class, I would like to use this opportunity to let you guys know about our trading bots and our trading academy, which if you're interested in, it's going to help you to, trade on your behalf. Once you set everything up properly the way it's supposed to, it's going to identify trading opportunities, manage those risks for you and everything. Once you set them up without you needing to be in front of your chart, then please feel free to reach out to us and we'll be more than happy to assist you set everything up the way it's supposed to be set, okay? With that out of the way, I look forward to seeing you guys in next week's edition of the ITU Forex class. Once again, I sincerely hope that you found value in today's class, and I look forward to seeing you guys and hearing from you. Thank you, and have a wonderful rest of your trading week. Cheers.